Hello traders, and welcome to lesson 3 in the ReadFX Beginners Forex Trading course. So in this video I'm going to explain what Forex prices are and how they work. In the last video then we had a look at the Euro US dollar and we saw a single price, but your broker is actually going to give you two prices. Now the image below shows the buy and sell buttons for Euro US dollar, and you can see there are two different prices. One is called the bid price and one is called the ask price. Now the sell button displays the bid price and the buy button displays the ask price. If you click this button, what you're saying is you want to buy right away at market with what's called a market order, and I'll explain that in another video. But you're basically saying you want to buy at the best available price right now, which is the price displayed here. And if you want to sell right away, you want to sell at the best available price in the market right now, which is this price here. So let's see where those prices come from. Now the bid price is the highest offer that a buyer has made, and the ask price is the lowest price that a seller will accept. And the prices change constantly as trades are taking place in the market. Let's have a look at that. The Forex market is a marketplace just like eBay. So let's use that as an example because most people are familiar with it. And instead of selling Euro US dollar, let's imagine that our seller on eBay is going to sell an old TV. So the seller sets an asking price of $100 for his TV, and a buyer comes along but he doesn't want to pay $100, so he makes a bid of $99. This is what it would look like. So our sell button would display the buyer's bid of $99 and the buy button would display the seller's ask of $100. The difference between the two is the spread, and that would be $1. Now, obviously trades are taking place all of the time in the Forex market, which means these prices never stop moving. So let's see how that happens. Well, what we have here is something called the order book. Now in a marketplace there are more than just one buyer and seller. There are thousands and thousands of them. And the way that prices work is they always display, as you know from the earlier slide, the best prices. So the highest bid from a buyer and the lowest ask from a seller. So if we look at all the bids from buyers, you can see we have one at $99, one at $98, $97, and so on, but only the highest bid is going to be displayed. Equally, we have more than one TV for sale. So this seller wants $100 for his TV. We also have other sellers at $101, $102, and so on, but only the best price, the lowest price from a seller will be displayed. And that's what you see here. Now, what happens if somebody comes along and actually presses the buy or the sell button? These prices are going to change. Let's see how that happens. In this example, our TV has been sold. Somebody came along, they saw the $100 price and they pressed the buy button. So that TV has now been sold. It's no longer available for $100. Now the next best price is this seller who wanted 101. The buyer didn't buy it, a new buyer came along, so this buyer's bid is still in the market. So we now have a bid of $99, the new TV for sale at $101, and the spread has now increased from $1 to $2. And this is happening hundreds, if not thousands of times every single second. People are coming into the market, pressing buy and sell, new people are placing bids and new sellers are selling stuff, and the prices never stop moving. To recap, in this lesson we explained bid and ask prices and we explained why prices change. In the next lesson we're going to look at the bid-ask spread.